Welcome back to the podcast. Don't forget to go to the website at retireyoungaudio.com and leave us a comment. Also, subscribe to the Retire Young podcast at Apple Podcasts, iHeartRadio, and Spotify. So, Al, in the last segment, you were talking a lot about these different markets as far as the futures market, the Forex market, and the options market. And we alluded to how the institutions are participating in these down markets. And investors can do that in their retirement accounts. And a lot of people that we're seeing are using options to do that.
Right.
It's called shorting. So explain what shorting the market is. How is the institutions shorting the market and participating in down markets?
Yeah, shorting is kind of the go-to method for the big players, the big institutions, to make money in a down market. Basically, what someone's doing when they're shorting is borrowing shares of something they don't own, selling it at that market price, and then because you have the obligation, since it was borrowed or loaned to someone, that person has an obligation to return it at some point in time. The goal there is to have it sold at a high price and then bought back at a lower price and returned to the broker. That's essentially shorting. Shorting can be done with the markets in general. It can be done on individual assets. You cannot short in an IRA, but again, using an option or selling a futures contract or Forex contract, that's going to get, or using an inverse ETF, that's going to give you essentially the same result. It's making money, or it's participating in the market as it is going down. And there's really two things that I think separates the institutions and the institutions' consistent profitability from what happens to the public, to the routine, or to the trader that is not part of an institution. Number one, the institutions know how to make money, how to participate in markets, whether they're going up, down, or sideways. An individual investor can do the same thing with the right assets. And number two, they know how to manage risk. They don't lose, and when they do, well, they don't lose often, and when they do, the losses are much smaller than the wins. That's something that's very important for anybody who's going to be in the market, regardless of what that asset is that you're trading.
And to clarify that shorting concept is, trading and investing nowadays, back in the day, it used to be you had to call your broker. Now it's all electronic.
Right.
So if an investor wants to short the market or be able to participate in a good way in a down market, it's just a click of a button on their platform. Whether it's a buy, it's go up, a sell first, they can participate in a down market. And what's amazing is, think about this. When you see TV and any financial show that's going on, they're portraying up markets as great.
Sure.
And down markets as the end of the world.
It's a bad, scary thing.
Those are phenomenal opportunities,
Right.
and the markets are going up every single day. They're going down every single day. They go sideways as well. That's why it's important to have that strategy for every market conditions, because you don't know which way it's going to go. But if you have proper strategies, proper risk management, does it really matter which way it goes?
No, there's really two components to participating successfully. One is identifying the proper entry and exit points. That's essentially kind of timing the change in price of something based on that supply and demand imbalance. And number two is identifying the right asset to participate in during different market conditions.
I'm glad you mentioned that right asset. I want to get into a question I want to ask you here in a second, but I just want to give away some tickets to an investing class because, Al, we have a lot of listeners that if they could see us right now, if they're watching the podcast on YouTube right now, they're probably looking at us like we have two heads. How do you participate in down markets? They want to understand how the institutions are doing that. You mentioned multiple assets and people that have 401ks and IRAs. Here's a common theme that I see when we talk to a lot of people is, I have a 401k and I don't even know what's going on with it.
Exactly.
Now, think about this. Investors and the public are putting their hard-earned money into an account every week, or every other week, I should say every other Friday, and they just let somebody else manage that.
Right. It's kind of like putting your money on cruise control. It's sort of like getting in your car here in whatever town you're living in and heading to someplace that's 1,000 miles away, just putting your car on cruise control, crawling in the back seat and taking a nap and expecting to get where you want to go. That's what a lot of people do with their 401ks. And think about it, when someone retires, what is there that they can rely on to kind of determine the lifestyle that they're going to live in retirement? It's the amount of money that they have available in a retirement account. Or if the money isn't there, then someone has to rely on Social Security. Or if you're lucky enough to have a pension, maybe a pension. But most people, I think the percentage of people that have pensions now is under 10%. It's around 6%.
Yeah.
So
You brought up a good point there, Al, though, because, I mean, question here, do we have a retirement crisis?
Absolutely. Not only do we have a retirement crisis, but it seems to be, especially with what's happened here recently, worse. And one of the things that's happening, and this happened back in the last market crash and recession we went through back in 2008, early 2009, people took money out of their 401ks to survive, to live.
It's happening again.
It is happening again. In fact, Yahoo Money did a survey. They found that over 165,000 people already have taken hardship withdrawals from their 401ks or 403bs. And we're talking about amounts of money that are in the hundreds of millions of dollars. They figure over $320 million have been removed from retirement accounts.
Well, what can people do, Al? Because, I mean, people have 401ks. Is there opportunities to manage them?
Essentially, you're managing them right now. If you have a 401k, 403b, and a plan sponsor is not having regular meetings, giving advice on what to invest in, how to change what you're invested in, who does the responsibility fall on then? It's the individual. It's the retiree that has that plan. And first of all, the choices are limited. And to be honest with you, they're mediocre. Most of the time, they're mutual funds.
Well, the mutual funds underperform the market anyway, so they're in an uphill battle no matter what.
Right. Over a period of time, 90% or more of the mutual funds underperform what they're supposed to perform with. Say, if it's an S&P 500 mutual fund, they underperform the S&P 500. And that's a high percentage. And part of the problem is that there's fees. There's heavy fees in there. And when somebody is paying a manager to manage a fund, that person typically feels I have to do something to justify their salary, which is typically pretty high. So they do a fair amount of trading, and there's a cost involved there.
A lot of fees.
The choices are mediocre. There's fees that are being issued to the individual retiree. And there really is no way of participating in a down market. The only way that an individual will make money in their retirement account, in a 401k or 403b, employer-sponsored retirement plan, is if the market or the assets go up in value.
You know, Al, we see a lot of parades every summer, and you see
we used to.
We used to, correct, but we'll see them again. But, you know, just an illustration of what happens to people's accounts in down markets. Remember those pretty girls that are on the cards and they're waving?
I do.
That's kind of like the pageant winners and stuff like that. They're kind of waving goodbye to their retirement accounts. That's what happens in down markets. But it's unfortunate. But here's the thing: people aren't alone. The good thing is there's other opportunities that they have. But investors can participate in their 401ks, especially their IRAs. In the next segment, I want to talk about how people can self-direct and have more opportunities. But the institutions, they're putting people in funds that make them the most money. I mean, most investors probably know that now. But people are afraid to take their money and manage them themselves. You can be comfortable. People just need to learn the skills. Investors just need to learn have the knowledge to do that. And it just comes down to financial literacy. And Al, we have these investing classes where we introduce people help people with that financial literacy so they have more confidence in their retirement decisions, so they're more comfortable to maybe take them over if that's the goal that they have. Thanks for listening. Don't forget to check out the website at retireyoungaudio.com and leave us a comment.